Hello accounts people, time to have a look at ratio analysis for AAT, T-level accounts, or in fact any other accounting course. Let's have a look then. So different parts to it. First of all, learning the formulas, the common formulas. They're the same on the new AAT level 4 syllabus as they are on T-level accounts. And then understanding, so being able to either write bullet points or sentences that explain, or tick box type questions, which you can do later. Obviously depends on which syllabus you're on. So I've got a set of accounts. I have borrowed it from an Osborne practice paper. However, I've changed a few of the numbers and added a couple of things in just to make sure we can do all the ratio calculations on one set of accounts. The whole video is going to take just over 40 minutes. As far as the calculations are concerned, if you want to take a screenshot so you've got these numbers in front of you, you could do them with me. That works quite well from a learning point of view. And I've also notably got the change in equity, because actually that 14378 figure may be one of the figures. There are exam questions going around where you've only got partial information, so you could actually use a change in equity, and that 14378 is the equity of the business. So the way I've gone through it is in terms of where you get the information from, rather than the sort of categories that vary from syllabus and board and accountant to another, and which category some fit in is always debatable. It doesn't matter, the ratios are the same. These are pretty much standard ratios. However, there's no rules, there's no laws. They're for internal use. There's no IASs or IFRSs saying what they should be. Even arguments over 1 decimal place or 2 decimal place might vary from one person to another, one accountant to another, or one investor to another. If it's an investor doing it for themselves, they're not governed by any rules at all. So we'll have a look at the theory and the limitations right at the end, the pinch of salts with a quick demo, but we'd better get on with doing some calculations. So we'll do the ones that are from the statement of profit and loss first. So these people have often come across, so gross profit margin, familiar with anybody who's done level 3 AT or BTEC business or anything. And okay, bit misunderstood sometimes. It's a contribution effectively as a percentage of sales. In other words, the difference between the direct cost and the selling price, or selling price and the variable costs, as a percentage. So let's do this. Okay, so I'll click on the actual numbers to start off with, and after a while, because a lot of them come up again and again, I'll start typing them in. So the gross profit figure here is the 13050 divide by 250 times 100, because we want it as a percentage. So 49.2% gross profit margin. That would be incredibly high for a retailer. Some businesses though that would be quite normal. It depends on the barriers and the overheads. So you'd have to compare it against last year's or similar companies. Because it's times 100, that's a percentage. We will see some later that are times 365 for days. Some of them are multiples, those are the ones that students often describe wrong. Or an actual traditional ratio, something to 1. There's only 2 of them left that we do that way. And then this one, okay, so AAT's PAT syllabus says it's no longer operating profit margin. They're calling it profit before financing and income taxes. PBFI, obviously the acronym, hopefully will catch on more than the full text, because I can imagine a few students calling it interest if they were writing a sentence on it. So anyway, formula, we better do it. So that's now this one divided by that one times 100. And what is the difference? Well, it's always lower. It's got to be lower. It's effectively after trading, because everything below the operating profit line, the finance cost, valuations, anything, tax, dividends, that's going to be non-trading. And both of those we'd like them to be as high as possible. So this company is profitable, it is still making a profit. Big difference obviously in this company, lots of overheads. So this one isn't a specific one. There's only going to be two anyway on a proper normal set of accounts. So we'll do the admin costs one as a percentage of revenue. So equals, find the admin costs. No. Okay, it says minus, so I'll have to type the numbers in. And that one comes to 22.3%. So that's not an actual profitability. It doesn't guarantee if you drop it that you're going to make more money because the expenses can go somewhere else. But it's a monitoring one, and we want to keep costs as low as possible. So very, very common ones. If it's not admin costs, it's going to be selling and distribution expenses. Cost of sales as a percentage of revenue would be pointless because we've got gross profit. In this case, cost of sales as a percentage of revenue would be 50.8. The difference between that and 100%. And the finance costs are covered by two interest-based ratios that we're going to see. In fact, one of which is coming up now. So the interest cover is the operating profit or profit before finance and income taxes divided by, so this is a multiple one. So let's find, well actually we've seen this number, so we can just type it in and then the finance cost would just be below it anyway. 269. We could ignore the zero, obviously most people would note it's like the negative sign, or could be fancy and put the abs formula in. And that is literally, it's the how many times, it's a number. So you don't of course want to work $80 hours a week, 52 weeks a year for all the money to disappear into the pockets of banks and make bankers very rich, richer than they are. So we need to keep an eye on that one. That will work alongside gearing and a few other ratios as well to tell you something about the business, but a very similar story. And the 22.3% very is a storytelling rather than an absolute figure that you look at. So the next two effectively are a pair, so we'll do them together. We've got current asset to current liabilities. These are the ones that are still expressed as a ratios, although you may see somebody expressing them as a percentage, and that's near and immediate future. So okay, so the difference is actually only the inventory. Inventory partly because businesses who are in trouble often have inventory they can't sell, but also because inventory needs selling, then you've got to get the money in from your debtors, from your trade receivables. So there's a time element to it. So let's do the calculation anyhow. So these are both off the statement of financial position. So current assets is there divided by the current liabilities, but we want it to 1, so I'm just going to retype it. Excel won't do that for me very well. And this one is going to be current assets minus inventory. So similar, so current assets minus inventory divided by current liability. So that will be 1.421. Quite common, one decimal place, no point being much more accurate than that. These are, well, you notice I put a big but in them because we're looking at the end of the year, not the current year, so by the time you see the numbers off a set of accounts, it's well and truly out of date because things like the bank go, very changes on a daily basis. So generally speaking, we'd want it to be high, although too high would be what we'd call a wasted asset. We could make this look very good by having lots of inventory and lots of receivables. Well, that's not good. If it's too much receivables, then it's wasted assets. So that's what the big but is about. And then the gearing, different spin really, is essentially, I'll explain that first, how much the company's financed by debts. Are you here, 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 or here? Generally speaking, 50% is higher geared. The formula, okay, well, it says total debt, but as far as AAT is concerned, total debt just means the bank loan, non-current liabilities, would include a debenture as well if there was one there, and trade payables, other payables, and overdrafts aren't included in this one. So, well, that's how they do it, so we'll stick to it. So the total debt is just going to be the bank loan minus I read the formula, total debt, so the capital employed effectively, except we don't use that phraseology, but it is the same as capital employed. And it's a percentage, so back to being a percentage. And what have we done wrong? That's better, 10.6%. And lower but not zero, there is an argument that says if you're not using some form of loan equity as a form of capital employed rather, then you're not using all the sources of finance available for the business. So it should never really be zero, there's always going to be something. So the next few, a little bit mixed bagged, they're in little groups anyway, so these use both, so we're going to use more than one financial statement to calculate the rest. So the mother of all ratios, what have the directors done with the capital employed available to them? And higher is going to be better, of course, the more they generate. So formula, okay, PPI, okay, we've seen that one before, so we just put the number in. So the capital employed, again, we've just done it, but I'll do it again. So capital employed on this set of accounts means the bank loan and equity, because effectively that's how much the directors have had to play with. 9.6%, it was 100. And then similar formula but slightly different numbers, so they really go as a pair. You wouldn't want, one is not better than the other, they are both important. And for a few seconds, and this one is the profit after tax over total equity. And so just about equity is essentially, because it's after tax, this is a percentage that can be paid in dividends to the shareholders, and the rest of it will be retained earnings. So we'll find the profit after tax figure now, because I've got a comprehensive set here. I need to use the right one. The profit for the year is better. T-level students will use the profit for the year figure, because the comprehensive income is because a building or something has grown in value over a period of time. It's not telling you anything really about the business or the running of the business. It's one of those things that happens if you own property, or land. So we'll use that one, and then we'll find the equity, which we could have got off the statement of change in equity, as 106.7%. And of course, shareholders always want more. They always want money to keep retained earnings. So the next are a little bit more in terms of efficiency and working capital. So efficiency, working capital overlap a little bit, which is why I don't get too worried about the categories that some people use. So the next two are about inventory, two different ways of expressing effectively the same thing. An asterisk there, because we're using closing inventory and we're using cost of sales. It's not a perfect world. We'd really like to use purchases and an average. Did used to use average. And of course, the more we turn over our inventory, the more sales we're making, the more chance to make a profit we've got. So, alright, so this is a number times. It's not got 100 times 100 in it. So just a multiple. So we've got the cost of sales going to type it in, divided by inventory, and we have 7.4 times. So this business has turned over, based on the available figures, inventory 7.4 times. Now that is based on closing inventory, which may be very different to opening inventory, so you would have a look at that and check last year's, or maybe even use an average. So the proverbial pinch of salt that we're going to have a bit more discussion on later. And then very similar effect, but we're now going to turn that into days. So we could actually just do 365 divided by 7.4, or we could use this formula, inventories over cost of sales times 365. So the inventory was, go back to where it was, and there is the cost of sales. So that means inventory on average is sitting on the shelf for 49 days. Now if you're a fruit and veg retailer, that's not very good. That's an awful lot of mouldy potatoes and carrots. But if you're a building industry, or it's wood and metal for construction or manufacturing, then that's a bit more realistic sometimes, because obviously deliveries of things like building materials, you have to have a lorry load together. So compare it against similar businesses rather than the ideal. So this is about getting money in off your customers. We're going to do it in days. So credit customers, but it's not purely credit customers. Maybe I should change that to customers, because we've got to use trade receivables. Well, we've got to use trade and other receivables, so prepayments and other adjustments are in there, and we're having to use revenue, not credit sales. But it's still a number, it's still a useful number. If something's going wrong on collecting money in, or patterns are changing, it will show. So trade receivables, we've got that number, and we've got the revenue number we've seen before. So it's taking 38 days on average to get money in from customers. If you're offering 30 days and you're not the most important supplier to your customers, that's quite good in today's terms. Having said that, because we've used the revenue figure, that could also include some cash transaction where the money comes in immediately. So patterns and understanding it. If you were doing a management accounting calculation for this one, and this is in some management accounting papers rather than financial accounting papers, you would have the actual receivables and you would know the credit sales figures, and it will be up to date. It won't be something that was published 6 months ago. So the opposite to that is about the money from, or paying your suppliers. How long does it take to pay your suppliers? So in other words, the money going out. And again, we've got to use trade and other payables, which could include accruals. And the worst thing about this one in terms of quality is the fact that we've got to use the cost of sales figures, 13,450. When really we would like to use purchases, and possibly even use an average. But again, if there's a change, if something's going wrong, it will still show up. The days will be longer or better than last year. Bit debatable, this one. Obviously it's always good to pay your suppliers on time, but if they're offering you 30 days, you paying them 24 days, they're not going to really bat an eyelid. If you are able to say to your sales reps that are visiting you, oh, we're really good at paying, yes, there'll be a little bit of a silence, because they're thinking you're going to ask me for a discount, and I would be thinking I'm going to have a discount off you because I'm good at paying my suppliers. It doesn't necessarily go down as a discount receivable, a prompt payment discount just goes in the negotiations most of the time. So the next two, we're getting towards the end of the ratios. So the actual asset turnovers. So net assets, in other words, how are we using the assets involved in the business? So very similar in a way. You'd expect the same sort of patterns in terms of rises and falls to ROCE. The ROCE is what have the directors done with the money available. This is what are you generating. However, is misunderstood because it's pound, although we could actually times 100 and turn it into a percentage. Some people would prefer that, and of course the more you get out of your assets, let's put this one in as well, the better. So this one is not the net assets, it's the non-current assets, so property, plant and equipment. So very important formulas. Again, they show a problem. If you've just bought some property, plant and equipment, hasn't generated any money yet, it will look very, very different, and that will need explaining to the shareholders why the ratio changed so much. So we're going to use the net assets. Now we haven't got the net asset figures on this style of account, so we're going to use total assets minus current liabilities. Right, so the revenue, no, that one we've seen that one a few times, divided by, so the total assets figure we haven't used before. So there's the total assets figures, and then minus current liabilities. So £1.60 effectively. So for every pound of net assets, we're generating £1.60. And this one, we're going to use the non-current liabilities. So let's do the formula. So 2650. Again, we haven't used this figure before, so it's easy to find though. Right at the top. £2. So every pound of non-current assets is generating £2 worth of revenue. Again, but imagine you just bought some new property, plant equipment. It's only got a little bit of depreciation on it. It hasn't really started to generate income for you. So what looks worse immediately, if it's the right decision, will go better in the long term. So this one is the last one. It's a combination of three that we've already done. It's the working capital, and it's the time from when you pay your suppliers to receiving money from your customers, which can actually be negative. I'll explain that after we've done the calculation. And it is the inventory days, how long it's sat on the shelf, plus the time getting it in from your customers, minus how long you took to pay your suppliers. 30 days. So you have to finance that. You have to buy the inventory, whether it's used in a service or actually whether it's used as it's actually what you're selling. So this could actually be negative. You would actually want this to be as low as possible because you haven't got to finance it. Why would it be negative? Well, yes, I used to deal with a business with a negative working capital. It was a bar account that belonged to a charity. The brewery took 6 weeks on direct debit to take the money out of the bank account. Well, the beer was drunk within 3 or 4 days, 2 deliveries a week. And the sales were predominantly cash, with the odd cheque for a big event or something like that from people who were paying for everybody else's drinks, and then just overnight balances of receivables on debit and credit cards. So you imagine the inventory was like 3 or 4 days, receivables was less than a day, and the payables was 42 days on average. So it's worked out about minus 35. Good way to run a business from a finance point of view. So those are the main formulas. I mentioned a few of the issues, which will mean I'm going to do them all when we look at pinch of salt. Just a quick demo, part of the pinch of salt really. I've done these numbers already. Okay, so top one. 2 firms, how to make yourself look more solvent. Well, what is the difference? Same inventory, same receivables, same monies. Cash is a current asset, overdraft is a current liability. If we turn that, as we should do really, in cash and equivalents, suddenly we look a little bit more solvent, and yet we've got exactly the same amount of money in the bank, exactly the same receivables, inventories and payables. If you're doing that for the wrong reason, that's unethical. If you're doing it to comply with the International Account Standards and IFRS 18, that's fine. be consistent. And somewhere under your notes or pages of notes, you will have explained what's included in it. That works great for the current ratio, but actually if we do the acid test, suddenly take off the inverse, it looks worse. 0.8 drops to 0.7, so what worked for the current made us look better, didn't work for the acid test, just to prove what can happen with these ratios when you change them. Right, so now, okay, last bit of theory. Just a few notes. We could actually write a book on the limitations and use of ratios. So for a start, if we're looking at financial ratios, they're all out of date when they're published. That's because it will be up to 9 months before it appears in companies' house records and can be seen. And the revenue figure will be a whole year. So, okay, you've got to have an AGM in the meantime, but the revenue figure will include sales 21 months ago to 12 months ago. No, sorry, 9 months ago. So, yeah, not brilliant, but it's the best we can do, unless, of course, we're looking at our own numbers. Industry averages are great, they're very useful, they're a good indicator, but you've got to be similar or understand that your difference and the effect it has. So a new company won't have a history of retained earnings building up, so the equity will be lower. That means the return on equity is not very good. And they may still have some additional startup costs. So, okay, most startup costs are before you start trading and in the first year, but actually you will see some in the second or third year of a new business that's still establishing itself, and they're to do with the startup, so they're not going to happen again. Then the size issue, the smallest one in the business, or the one still largely owned by the founders. Well, yes, you could still have share capital of £1,000, £1 shares 40 years after the business started, whereas everybody else has been sold and been around for decades and been multiple owners and has got much bigger share capital, and that will affect all the ratios. And if the business is there to provide living for the directors, the main people involved, maybe sort of, plumbing or engineering or something. They're not trying to take over the world and dominate the world or grow. They're taking most of the retained earnings out because it's theirs, and why not? If there's 2 directors own the business and it's their living, they won't be keeping retained earnings in as a more commercial investors type company will. And then there's lots of other costs for different reasons, one-offs, there's a few coming down later as well, and the directors have to be prepared to explain these to the shareholders. And as you may have seen, studying Dave, or depreciation's got to go in somewhere. A percentage to cost of sales, a percentage to admin or whatever. One company might do it very differently to another, and of course have a different depreciation method which will change it. However, of course, they will be in the notes under IAS 8. How many pages of notes are normal? Well, lots is the answer. Enough, sufficient. Tesco's about 128 pages. I looked at local council recently, it was 70 pages of notes. Much smaller organisation, but it's still 70 pages of notes. Okay, so interpretation, we're using the end of year numbers. We're using closing inventory, closing receivables, and it may have changed in a year, so it's not telling you the true picture. If you've got last year's with you, you can see big changes and therefore can ask directors questions if you're an investor. Take out a loan in the last month. That will affect the current and acid test if the money's still in the bank, favourably obviously. It will reduce return on capital employed because the money hasn't turned into a return yet, but it's part of capital employed. Asset turnover, well, depends whether it's just a net asset still or whether it's a non-current asset, won't make that much difference. But actually, in terms of the revenue hasn't come in, but the asset's gone up either way, so that'll change that dramatically for the worse. It'll look worse. And then interest cover, you've got the loan, you'll have an accrued interest maybe for a month. And again, no revenue, so the interest has gone up a little bit, but the revenue hasn't. And then gearing, well, it depends actually how you use the gearing, but of course it's part of the gearing calculation, it's part of the formula, so it will affect the gearing. If you've just taken out a loan, there's nothing coming back to pay it off. And then a long-standing argument, ROCE, my mother of all ratios, you're using the end of year figure. Well, strictly speaking, the directors have been working on the start of the year figure, because a loan at the end of the month or part way through, they haven't had a chance to generate the return with. So actually, arguably, you should be using the start of ROC, or for a few seconds calculations, look at last year's, look at this year's, do both versions. 5 seconds pressing buttons on a calculator. And then the inventory, we're using the closing inventory. Notice there was no mention anywhere. Okay, it was in the cost of sales formulas of the closing inventories. Should we use the start average? Well, when I first started teaching over 30 years ago, we used to do average inventory, average receivables, what it's called, debtors in those days. And therefore, if you'd have to have about 4 sets of accounts to do 3 sets of ratios, 4 years worth of accounts. So some people still prefer to do that. And then credit sales is better than revenue for the receivables days, so it's not quite a figure, and it's going to overlap with the next point. And then, okay, how about it's the end of the year, spend some money on the budget. So, we had a budget for some property, plant and equipment, we better buy it, otherwise we'll lose it next year. Again, you've got the outcome. It's going to affect the ratios, but there's no revenue yet, because your new equipment hasn't generated any revenue yet. And then the figures we really would like to use may not be available. Now, if you're management accounting, they will be available. You'll see the breakdown. What do we see in the set of accounts? We see trade and other receivables at the end of the year. We really want the receivables figure, the trade receivables figure only, because the trade and other receivables is going to include prepayments, or an insurance claim, could include other assets as well, or contingency assets even, something that's going to come in the near future but isn't a trade receivable. Loss on disposal, what do we do with that? Well, we hide it in all sorts of places. It could be in cost of sales, in which case it makes the cost of sales figure erratic for a year, because we don't necessarily make a loss on disposal every year if it's a small medium business. It could be hidden in the admin costs. Where is it? Who knows? We could actually make a gain on disposal as well, and that will change some of the ratios favourably, of course. And then the cost of sales, we're using that. Really, we want to be using purchases. Management accountants can. If you're looking at somebody's set of accounts, you can't. And then a bit of a change, financing, so just think logically through the ratios, try and think, if you were having to tick boxes, which of these ratios can it affect? Well, a share issue is essentially, in a nutshell, anything to do with equity and where has the pound that's come into the business gone. So ROCE is both the top half and the bottom half. The return on shareholders' funds, the old version of return on equity, because the equity's gone up but no return, or the return would be long term. Current and acid test if it affects the bank account. Asset turnovers, because the net assets have gone up if you spent some money on property, plant and equipment, or even if it's just in the bank account still. And the gearing will be completely refocused if we've got a share issue, because the percentage of the business financed by loans will naturally go down. And if you use the shareholder issue to reduce some loans, it'll go down even more. So, oh look, we've reduced the gearing. Well, yes, you've had some money off the shareholders. We're sitting there wondering what you'll do with our money. We know that, we've given you the money. So any action to improve. So this is kind of the flavour of the newer sort of exams, and the fact that you've got to think you can do one thing, it may solve a problem, but there's an additional effect. So if you have the share issue purely to improve liquidity, yes, there's money in the bank, it will improve liquidity, it could stop the business from closing. But then everything else, ROCE, return on equity, is going down. Raising funds expansion, well, a big time lag. Property, plant and equipment a few years. If the expansion is moving to more efficient or suitable premises, we've seen that in T-level papers recently, could be 10, 15 years before it pays off, even though it's a really good idea. And shareholders, what do we do with them? Okay, if you're a shareholder in a business turning up an AGM, they're going to sit there on their calculator. Okay, I'm old enough to have been where everybody was present at an AGM as opposed to online post-COVID, and rooms full and halls full of people. And yeah, you give them out the paper copy of the accounts, and the first thing they do is they have a quick look at them, read a few notes, and then you get the calculator, go bang, 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 doing the ratio calculations. So as a director, hopefully, or one day, a finance officer or senior finance person, you may have to answer some silly questions from some shareholders. The silliest one I ever had, having actually already explained the general year, the chair person had actually already gone through. We've had a good year, the volume has gone up, so 25% volume increase. Somebody thinking that the 4% increase in admin cost was ahead of inflation. But it's a fixed cost. Of course, it's not fixed. If you are going to increase your volume by 25%, some of your admin costs are going to go up. More invoices, more ink, if nothing else. Also bear in mind that directors are appointed on a yearly basis at an annual general meeting. It's one of the first points at an annual general meeting. Usually the first. So actually, strictly speaking, when they're presenting the accounts, it's last year's board of directors and they are new directors. Now, most of the time, it's the same old faces, the same people continuing. Might be one or two minor changes. It's very rare that it's a complete new board of directors. But you're actually grilling directors as an investor on what they have done with the money. Well, wasn't anything to do with us. This is what we've taken over for you this year. Have seen it where students have written answers about directors using the ratios. They don't use the ratios. They've got much more information about the company's performance and finances. They will have done the ratio calculations because they know the shareholders or the banks if they were going for a loan, or suppliers if they're negotiating with a new supplier, will have sat on their calculators and done the ratio calculations. So they do have to know what they are and understand them. And obviously the point I have mentioned before, management accountants will have the correct figure. They will have purchases. They will have up-to-date numbers. They will have today's bank accounts. And so management accountants are using slightly more up-to-date figures. There's no reason why you couldn't calculate the ratios as a performance measure along with other performance measures on a monthly basis for a business. From the examiner's notes on AAT, what are they looking at in the new syllabus? Well, it's essentially strong liquidity, low gearing means the business is financially stable. If the profitability is weak, that means low margins and therefore no ROCE, no return on the capital invested. So it's either usually high down to high cost is the most likely one, or bad pricing strategies. And then we can only be reasonably efficient. It's very hard to compare one business to another. It depends on the buildings, the structure, the size, the financing. Two very similar companies will look very different in terms of the balance of cost of sales and overheads. But of course you can as a business always be looking to reduce your inventory, keep it fresh, keep it accurate, and also control the receivable days. And to do this, control admin costs. Admin costs, there's loads of them. So the numbers that we see tell a story. They're okay, but but we haven't got every precise figure to look at. It's saying that generally costs aren't being controlled in admin if it's going up. And obviously look at the pricing or margins. So for instance, you could drop your prices in order to sell more, so that will reduce your gross profit margin. That makes you look worse. However, if it works and the volume goes up sufficiently and you've got your sums right, then your operating profit margin will be better. So we can do that. If not, you focus on reducing the costs and increasing the margins that way. And in the working capital, obviously that balance between paying your suppliers, inventory on the shelf and receivables is one of the most important things that you look at when you're running a business, because you have to make sure you have money to pay your bills at all times. Otherwise, you go into administration. So that's a wrap.